Hello and welcome to Morningstar. The Asia-Pacific region offers a wide range of attractive income and growth opportunities in both developed and emerging markets. To talk about such opportunities and the risks associated with those markets, today I'm joined by Jason Pidcock. He's an investment manager in the Asian Equity Income team at Jupiter Asset Management. So Jason, first of all, why do you think investors hungry for income, European investors more precisely, should look at Asia in this moment?
As you mentioned in your introduction, Asia offers growth and income. And what we're looking for is companies that have an ability and willingness to pay attractive dividends today, but where they'll generate earnings growth that can fund dividend growth in the future. So we're not looking for a static yield. We're looking for a growing dividend stream. And we do find enough growing companies in the region. Either they're growing from relatively high domestic consumption in local markets like India, or they're very successful exporters who see the whole world as their marketplace.
Right. The strategy that you co-manage, the Jupiter Asian Income Fund, which excludes Japan, by the way, has been able to overperform peers and the Morningstar category benchmark over the last 4 years. What were the winning choices in this regard?
It's been from a combination of country selection, sector allocation, and stock selection. One of the biggest benefits from a relative performance point of view was a very large underweight position in China, which we then took to a zero weighting in July 2022. And we haven't invested in China since then, even when the market has had temporary bounces. So we prefer the more developed markets in the region, and we're very selective when it comes to emerging markets. We have had a decent position in India, which has helped, but a lot of our country performance has come from countries like Taiwan, Singapore, and Australia. We've been overweight tech, that has helped, and we've been underweight some of the sectors which have underperformed more recently, such as healthcare. So it has been a combination. We're very stock focused. We only have 30 holdings, and some of our largest holdings, particularly in the tech sector, have done very well for us.
Very interesting. And specifically, if you had to name 3 stocks, 3 income stocks that you are particularly positive about right now, what would they be and why?
There's 3 names I'm going to give you are all large positions within our fund. They're top 5 holdings. 2 of them are tech companies in Taiwan. We remain very positive to the outlook for the tech sector, particularly companies that are benefiting from AI-linked demand. So these 2 companies are Honhai and MediaTek. Honhai is the world's largest contract manufacturer. So it makes products to other people's design. It's the largest contract manufacturer for Apple. It makes more iPhones than anybody else, but it has many other customers, including NVIDIA. And that has given it a lot of growth recently. Honhai do have manufacturing capabilities globally. And recently they've been in the headlines for shifting some production from China to India very successfully. Just today, it was announced that $6 billion of handsets for Apple iPhones have been exported from India. Another company is MediaTek. MediaTek is a chip designer. So they outsource the production of the chips to companies like TSMC, which we do also own in the portfolio, but they focus on the design. A lot of their chips go into mobile phones. And we do think that the replacement cycle of phones over the next couple of years will be very, very strong as people buy newer phones with AI capability. The third company is a domestic demand stock in India, ITC. ITC is one of the largest companies, consumer companies in India. It focuses on staples like food and beverage, cigarettes, agriculture, paper and packaging. It also has a hotels business, which it's going to partly spin off in the next few months. So for us, it's a very nice proxy on domestic demand growth in India. One thing that these 3 companies have in common is that they all have a net cash position on their balance sheet, which allows them to pay attractive dividends. They're also large cap stocks, and therefore the shares are very liquid. The market cap of Hon Hai is about $90 billion US dollars, ITC about 72 billion, and MediaTek about $65 billion. So they tick all the boxes that we look for in our portfolio.
That's very interesting. Finally, looking ahead, what Asian markets and sectors do you like the most?
Yes. So the key four markets for us in terms of absolute size are Australia, Taiwan, India, and Singapore. Those four markets make up the bulk of our portfolio. We see them as relatively low risk, but with high quality and growth opportunities. And in those four, we can have a mixture of global demand and domestic demand, but domestic demand where the addressable marketplace is relatively large, India being a much larger emerging market than most others. In fact, all others bar China. Sorry. We do see high dividends available in these four markets, and we're also able to get exposure to the sectors that we very much like, such as technology. So all of the stocks that we own in Taiwan are tech stocks. That is a sector that Taiwan does very well. It is growing because of AI-linked demand. And we do think over the next 2-3 years, growth rates there will be very, very strong. In Australia, we're playing a mixture. So we have commodities, infrastructure, but also financial services. In Singapore, we have companies that have a lot of their earnings from neighboring markets, particularly neighboring Southeast Asian markets. Singapore Telecom and DBS do have operations in many other markets which add to their growth. So between those four, we're able to get access to everything that we like, where liquidity is good, where we see governance risk as being low, and where growth prospects over the long term are compelling.
Jason, thank you so much for your time. For Morningstar, I'm Valerio Baselli. Thanks for watching.